If buying an apartment building was a movie, the name of the movie a couple of years ago would have been Get In and Ride, right? A couple of years ago. Now
it's the fans outside.
it's like, run, get out. Right.
It's like an episode of Heat.
Yeah. What is going on, DeRosa Insiders? This is Matt Faircloth. Welcome to the Cash Flow Digest. This program is brought to you live on the DeRosa Insiders on Facebook. If you guys are not followers of the DeRosa Insiders page on Facebook, what are you doing? There's such great conversations happening there. It is free. If you guys are watching this recording on Spotify, please take a minute right now and like this show, give it a 5-star rating. And I'm grateful for you guys to be with me here today on the Cash Flow Digest. Just as always, guys, we got a phenomenal program. We've got a great guest talking about the state of the lending market today. If you guys are not borrowing money, and if you guys are not doing real estate deals with your own cash, right? If you didn't win the lottery, maybe you need to borrow money for your real estate transactions. And we're bringing on a great guest who's going to talk to us about the state of the lending market and the way we can still get deals done. Because if people are out there telling you can't do deals with the way lending is right now, our guest is going to dispel that with all kinds of great stuff. He's even told me a little sneak peek about other tactics aside from just borrowing money through Fannie Mae, Freddie Mac. I cannot wait to hear about other fixed rate debt opportunities that he can tell us about and just what he's seen in the market, right? He's done LP investments. So he's one of us, guys. He's done operation stuff. He has the investor mindset. Our guest, Culby Culbertson, is going to be joining us to talk about lending, to talk about all things money. Culby, how are you today, man?
I'm doing great, Matt. How are you?
I'm fantastic. I don't know if I've ever had a bad day, man. I'm doing great. Hey, man, I just want to tell you how much I appreciate you joining us on today's show. Could you just give our guests that don't already know you, could you give our listeners a brief background on you?
Sure. Absolutely. Really appreciate you having me on as well, Matt. So my background, last 5 years or so, I've been in the capital market space, commonly organizing debt, ground up construction, value add renovation, refinances, a myriad of acquisitions. And just as you kind of alluded to before, various capital resources, not just Fannie Mae, Freddie Mac, which I've done many times over, but also various debt funds, CMBS, LifeCo, banks, credit unions, private capital, you name it. So I've got a pretty good pulse of what's available in the market and how to utilize that on different transactions.
Great. Let's start talking about this, right? Let's look back into the past and talk about back to the good old days, which was only like a year or two ago. I mean, DeRosa, my company, did this too. There was this thing that everybody was excited about called a bridge loan, right? And it was like, oh man, you mean like I could buy an apartment building and the bank will give me 80% of my purchase price and 100% of construction? And the lender would say, yes, absolutely, we will. It is floating rate debt. So you've got to buy this little thing called a rate cap, which is pretty cheap. Just throw it in your closing costs, a couple of, 10, 15 grand, maybe for a $10 million mortgage. No big deal, right? I'll just put that in closing costs. You'll be fine. And that'll cap your interest rate. And the interest rate's only 4%. So you can afford to pay that on a monthly basis and you'd be off to the races, right? And you would take that $10 million apartment building. You would raise maybe $2-3 million to do the deal. And then we would go out and add a bunch of value, do construction to the property, or that would be the business plan, increase rents, maybe untangle the tangled things, like maybe replace the roofs or whatever. And half the time, what people ended up doing, they'd buy these properties in like 2018, 2019, and the market blew up and took off, and they realized, I bought it for 10. I was going to get the value up to 15 and refinance it, but geez, I got people knocking my door down looking to buy it for 17 million right now. Maybe I'll just sell, right? So a lot of these folks just passed their hot potato problem down line. And also the business plan quite didn't work out. So a lot of these guys would go in, bought these properties, and they ended up kind of getting a little sideways and everything like that. And maybe rents weren't coming in the way they thought they were going to. The business plan didn't implement. And the market saved a lot of those folks, right?
Yes, sir.
Yeah, your comments there, and we'll get into what's going on today. So that's the way things were. Give me more of your revisionist of looking back as to the world back then. I guess we can't hit the rewind button, but it was the good old days, wasn't it?
Yeah, no, you kind of hit the nail on the head. A lot of guys were going in. It was very easy to get into a deal because we were linear. Let's face it. Pretty much since 2015, it just went straight up like this. All you got to do is buy the real estate. If you get in the real estate, you're going to make money. And obviously times have changed because, when bonds were distressed, treasuries sunk historically low, which put everybody in kind of this utopia, if you think about it, because really cash flow was really easy to achieve. Whereas now when we're kind of back to, status quo, I guess you'd say, it's now you actually have to put your pencil to the paper, do the underwriting, and actually figure out what your exit strategy looks like. Because if you go to a lender today and say, well, I'm going to buy this property and I'm going to raise rents, they're going to be like, well, how are you going to do that? And they're really going to challenge you to look at demographics, population densities, capital markets in general. So, call it 2 years ago when rates, even on a bridge loan, were sub 4.5% with the intent we're going to refi right into Fannie Mae, no problem. Those days are just gone. The sub 4 rate, I think, are probably a thing of the past for our lifetime. No crystal ball here, Matt. But I do think that, 2, 3 years ago, before say 2020, when really the rates started declining the way they were, if I were to bring Matt a 4.5 to 5.5% rate, we're playing ball. That's a good rate. That's
Yep.
something that you can achieve. Cash flow. You can still put cost into the deal and not jeopardize your debt
Yep.
service coverage ratios, which, mind you, is the biggest indicator for lenders to understand what kind of money you're making, right? Your debt service coverage ratio is the money you make after the debt is being paid.
Yeah.
So now these days, when your rate is double what it was 2 years ago, which, just to your point, there was so much bridge money going out at that time. Now guys are coming to the end of their management strategy when they didn't necessarily raise the rates that they thought they would. They didn't necessarily get the cost completed they thought they would because of inflation, labor shortages, the list goes on. Now they're holding the bag. And now rates are 6, 7% minimum. Now you have to actually know what you're doing.
Yeah.
So lenders are being very meticulous about putting money out that doesn't support cash flow day one.
So to rewind a bit about like what's changed and doesn't work anymore, right?
Mhm.
Like those floating rate debt deals, and debt didn't float that much. I mean, like,
Right.
debt would move like, a couple of basis points a month and everything like that. Oh, it's gone from 4% up to 4.1% this month or whatever. But rates have like effectively doubled, maybe even tripled based on for bridge,
Sure.
right? And because interest rates have gotten very squirrely, because the Fed's been raising rates, and because the certainty in the market's really gone, there's a lot more uncertainty than there is certainty now, right?
Yep.
Because of that, that's made that thing that was just a rounding error on your balance sheet when you closed a deal called a rate cap has gone from costing 10, 15, 20 grand to
Oh yeah.
costing over $500,000. What a rate
They're
cap is.
making their hay right now, Matt.
Yeah. Well, can you explain what is a rate cap? Let's start there.
That's a good question. So
Yeah.
what a rate cap is ultimately is just like it sounds. So they'll put a ceiling on how high your floating rate can go. Give you a perfect example. So I'm a GP in 2 apartment buildings in Temple, Texas. And 3 years ago, if I were to get a rate cap, it probably would have costed maybe 100 grand.
Hmm.
It was 180 units, good size loan, bridge loan. And we had a 2-year rate cap, 2%. And we were at SOFR plus 375. At the time, that was a pretty good looking rate. Now,
That's because
it's
SOFR was
okay.
trading at like 15 basis points, right? So if you're at SOFR plus 375, you might strike around 4. That's about it, all in, right?
So
Yeah.
so when we first closed, which is about a year and a half, 2 years ago, that
Yeah.
rate was somewhere about, say, 5.5, 6%.
Hmm.
Luckily, we have a 2% rate cap, which, mind you, costs about $500,000, Matt. Seriously. And obviously that was a gut punch, especially when we're trying to raise money, interest reserve, closing cost, insurance, rate cap. I mean, you're talking an extra $1 million easy.
Hmm.
And $1 is a lot of money, you know what I mean? But yeah, so it gives you 2 years with that
Hmm.
cap of 2% above. So for example, if you're at 375, your max cap would be 575. So we are capped today about 8%, which is fine. We're cash flowing, we're doing well. But there are folks out there that, because it wasn't always required, Matt. A rate cap was not always a
Hmm.
requirement because, just like you mentioned, the market was a little stagnant. And if it did move, it was a deviation that really didn't ruffle any feathers. And people were very comfortable because of the amount of capital market activity. People were doing it. There were so many folks just doing it many times over, making webinars about it and ebooks and blah, blah, blah.
Yeah.
And here we are today, and those folks are doing a fire sale, which is uncomfortable for everybody,
Hmm.
unfortunately. So you just have to be mindful of how fast time really does go, Matt, because even for us, you know, as an investor myself who is in capital markets every single day, I'm watching the clock because that rate cap is up next year. And I don't see any significant difference in the market to where we're going to be excited about what we're going to walk into. So it's just something to keep in mind.
Well, let's talk about that, and then let's talk about the dilemma that exists for owners that got in on deals with rate caps, and maybe what you're seeing beyond beneath the sheets there.
Yes, sir.
Then I'd love to transition with you, Colby, to talk about like anybody watching right now wants to do a new deal. How do you
Yeah.
get like how are we getting deals done? Let's go
Oh, yeah.
there next. But like right now to close that out, you've got somebody that's got a rate cap on a deal.
Mhm.
Rate caps coming due. Their performance isn't quite there to refi, to hit
Yeah.
Fannie and Freddie numbers, or so it sounds like their options are to maybe to re-up their rate cap, to buy the rate cap again, to
Yes.
keep their effective interest rate on the deal down, right?
That's what I
While
was
they
literally
finish
going to
their work.
say. I
Yeah.
was going to say, Matt, the best thing to do always talk to your servicer. If you're in a deal and you're watching the clock, like I mentioned, be open in communication because the last thing you want to do is have a fire drill. Being
Yeah.
preemptive, taking initiative. Look, lenders are just like me and you. They're guys that get out of bed for a reason. They go to work. They're understanding, especially in this market. Most of them are investors just like we are, right? But if you hide something
Yeah.
and you're not giving them the right information, it's going to be very difficult for them to go to bat for you. So anybody in that situation, Matt, I would just say communication is key. Make sure
Yep.
you're vocalizing any heartburn, vocalizing any positives. Say, look, we may need to extend this, but here's what we've done since we last did. Here's why it makes sense for you, Matt, to give me this extension. We've raised rents. Our occupancy is now 95%. We've renovated 4 units. We've done this. We've done that. As opposed to, hey, man, we haven't done it yet. It's
Hey, we'll get around to it,
it's
right?
it's going to happen. So I
So
think it's
open communication.
Yeah.
And you think that for deals, that the best thing for an operator to do is either to raise the money from their investors or take it out of cash flow or take it out of their own pocket or whatever, and buy a rate cap to kick the can down the road, to keep the business plan going, to make it to the promised land, to get to the next level, right?
Yes, but I would say this though, Matt, just based on where they're at in the deal, because a lot of times if they have done what they say they're going to do, I mean, typically most minimum rate caps are minimum a year, average is 2.
Mhm.
If realistically, if you're an LP and your operator has not created any value on a value add deal in 24 months,
Yep.
you're in the wrong place, for one. But two, at that point, you've probably created some value to where there are other avenues to pursue.
Mhm.
There's probably a vehicle out there, some type of debt fund, a bank that could ultimately be a better situation, because if you do the rate cap, there's two things. One, it's going to cost, not just with
Mhm.
the rate cap, but likely with the lender as well. And you're sitting on that same high interest rate.
Yeah.
So, it's very easy to say, oh, well, rates are high. But just like we talked about earlier, Matt, historically speaking, we're not too far off the marker. So there's a lot of banks, a lot of debt funds that ultimately could walk and talk just like Fannie Mae, Freddie Mac, maybe not as attractive, right? But you're also not going to be locked in for 10 years, 5
Yeah.
years,
You
maybe
mean that
2,
people
3.
can refinance multifamily into something else besides Fannie Mae and Freddie Mac?
Absolutely. Absolutely.
And that takes us to the next conversation. Maybe like the mantra, the context, or meaning like the theme of the movie. If buying an apartment building was a movie, the name of the movie a couple of years ago would have been Get In and Ride, right? A couple of years ago. Now,
Now it's the fans outside.
it's like, hey, run, get out, right?
It's like an episode of Heat.
Yeah, yeah. I think that the mantra now for multifamily is, how creative can you be, right?
Sure.
And so it's Fannie Mae, Freddie Mac are not the end all be all. I've heard of people talking to HUD these days, and that's not. I mean, HUD was like the redheaded stepchild that nobody talked to, that they kept in the
Right.
closet, and all that. But now people are talking to HUD because the rates are a little bit lower. You're kind of selling your soul a little bit because it can be a pain in the butt to deal with. It's going to take upwards of 6 to 9 months to close a deal and whatnot.
Yep.
But
That's being
HUD is
generous.
becoming a real thing, for closing refinances, right? What
Yes, sir.
else are you seeing on the refi side? You said debt funds, maybe small community banks, those kinds of things. Those guys are getting into the world. What are you seeing from them?
Absolutely. So to touch on your point about HUD, so for example, they are seeing more attention right now because deals are moving slower in general.
Mhm.
Analysis is taking a little bit longer, reports are taking longer, so on and so forth. So that 6-month waiting period versus, I don't know, say 60, 90 days, starting to be a little bit more normal. And then there's also other
Yeah.
programs out there that are government regulated, like USDA. If you're under a certain population density, you can use USDA, which is pretty competitive as well. And there's a myriad of different programs out there that's government regulated that may take a little
Mm.
bit longer, but once you're in, it'll be worth the wait, which I'm happy to elaborate with any investor that's curious about that.
Mm.
As far as like kind of the open market, debt funds are extremely active right now, man.
Mm.
There's a lot of groups out there that have, a good amount of structured money that's putting out 9%, 10% money with really no prepay penalty. It's called a minimum interest requirement. So you have to be in the loan for say 6 months, 8 months, 12 months. And even if you were to exit prior to that, you just owe the extra couple months of interest. Not a problem. That
Yeah.
way you're weathering the storm. You can kind of get through election year, which is also a factor that people aren't considering.
Yeah.
But debt funds, banks, there's a lot of different ways to do it with banks as well. Just the thing is, deposits are a big factor
Yep.
because now that rates are so high, it's hard to, we're in a yield starved market. So now they're doing these cash deposit accounts making 5%. That's pretty safe, right? So a lot of people are pulling their money out of the institutions and putting them in these CDs. So banks are just scrambling right now to get deposits. If you want to get a bank loan, which is competitive, right? You're at
Yeah.
prime minus 50 basis points a lot of times, which today prime is at 8.5. So to be in that scenario with a very flexible prepay plus interest only, that's pretty good capital, Matt.
Yeah.
But
Yeah.
you have to
Yeah.
be prepared for a depository relationship. So,
So Fannie and Freddie aren't going to ask you guys to post money with them, but we do a lot of work at my company with small community banks, and like they've kind of become not fallen by the wayside, and people think like, oh, that's for small deals. That's for if you're buying a 5-unit apartment building or something like that. That a small community bank is there for that. But and they are, and they're a great resource for that. Because of course you can't go to Fannie Freddie, but as a rising investor for me, you always wanted to graduate up to
Yeah.
those Fannie Freddie loans, and that's still possible. They still are lending money, but as Colby said. It does take them longer to close. They're not doing closings in 45 days anymore, right? And it was not a big deal back in the day when the rates were at 3%, 3.5%. I mean, I got a Fannie Mae loan at 3.1, believe it or not, Colby. So I know you probably sold debt in the twos for them back in the day, right? What was great about that is that debt is transferable. So if I go and sell a building,
Yes,
I
sir.
can transfer that Fannie Mae, Freddie Mac debt upline to my next borrower, which is why it doesn't scare me. Oh, it's locked for 5, 10 years, whatever. Guess what? I can sell it.
Here's
Not
another
so much.
factor, Matt.
What's that?
Here's another factor to doing assumable notes. It's actually, so it's only 1% to assume it. And if you're doing Fannie Mae, there's what's called a supplemental. So
Yep.
when you get a supplemental loan,
Talk
it's
about that.
essentially an in-house refinance to where you can still cash out essentially from some of the work that you completed, because Fannie Mae will give you CapEx dollars as well, which is different from Freddie SBL. So Fannie Mae does, which is typically loan amounts that are above 7 million, you'll get your CapEx, you'll get your interest only, you'll get a supplemental. So especially syndicators out there that are raising money and don't necessarily want them to ride the entire 7-year, 10-year term, when they get that completed, they can do a supplemental and take some of those guys out. So there's a lot of advantages to doing assumable loans if you know what is available to you with that loan.
In layman's terms, guys, a supplemental, what Colby's talking about, is simply what you might call from back in the day a second mortgage or something like that, right? But it's still coming from Fannie Mae or Freddie Mac or whatever it is. And it's a great tool to use. So guys, look into buying properties subject to the existing debt, especially because the debt is expensive as it's gotten recently. There's debt that maybe was put in place 2-3 years ago that you'll be surprised what the interest rate is. So Colby, where do you see the world going right now? Like, break out your crystal ball for me. Tell me where you think the debt world, the multifamily world, is going to end up in the next year to 2 years, and how do we as investors play into that?
Sure, that's a great question, and I just lost my crystal ball, so
yeah, I know mine's in the shop.
A little bit off the cuff.
Yeah, mine's in the shop.
We just had our recent Fed meeting, which we paused. We didn't raise any rates. All roads lead to one more increase of 25 basis points in November. Which I get it. We've been raising rates for almost a year now, 12 consecutive raises. But here's the thing. I do believe that we found a ceiling. So at this point, it does make sense that we're going to see a decline in our rates. And historically speaking, election years, typically we drop about 100 basis points. And I think we may even see more this year, because election year, they're going to use everything they can to essentially posterize themselves, right? They're basically going to say, for the people, we are going to lower rates, and I think that we're going to see
America needs relief. I was thinking of him saying that.
For you and you only, Matt. That's right.
I'm lowering the rate for you, Matt Faircloth. Everybody else got to keep paying 9%, but for you,
that's right. That's right. So I think we see a decline, which capital market activity I think it's going to explode next year, because a lot of folks are on the sidelines right now. So here's the thing too, that, most folks are saying, well, I want to wait and see what happens in the market. Here's the thing. If you're getting into debt that has a flexible prepay, you can play ball now, if not more versatile than you ever could, because there's more negotiation power in your contracts and everything like that. I think this time next year, it's going to be much more difficult to negotiate, because rates are going to be lower. The prices will be the same, if not higher. Just like you mentioned before, having the 3%, 3.5% rates, do you think they were selling at the same price? No, they were selling it based on the underwriting criteria, what it cash flowed to with that. So you're going to see an increase in prices as rates decline. So it's not like you're ever buying a significantly better deal because rates are lower, because they're just going to increase the price. So really right now, as much as it hurts to accept a 6-7% rate, 8%, as long as there's a flexible prepay, Matt, and you understand your management strategy, what are you going to do when you get in there? What is your occupancy levels now? What do you anticipate? So on and so forth. What's your yield on your cost? How much dollars are you putting in to renovate? How much dollars can you make on that premium rent? I think now is a perfect time to do that, because this time next year, even for the next 24 months, it's going to be a little bit more of a frenzy in the market, in my opinion.
Yeah. Guys, as you can tell, Colby's very knowledgeable on where things are. He's great at reading the tea leaves. I'm enjoying this conversation. And if you guys want to have a conversation with Colby, how do you folks that are up there buying, looking to buy properties, maybe looking to refi, looking for another set of eyes on what they got? I mean, everybody's kind of already got a lender already in their pocket. But at the end of the day, we all need backup quarterbacks and backup quarterbacks behind our backup quarterbacks to look at stuff. So Colby, how do people that want to maybe have you put a second opinion on something they're looking at, how do they get a hold of you to run what they got by you?
Absolutely. So my email, cc@culbertsonholdings.com, which I put on my tag here.
Yeah.
One thing you had mentioned, Matt, about everybody having a lender. Look, at this stage in life, we've all got relationships. That's why we are who we are today, all of us, including myself. But it does not hurt to have a second set of eyes, especially myself. I mean, look, I've closed about $350 million in loans over the last few years. I also own about $20 million in real estate. So look, if someone comes to me, I'm not so naive to think I'm going to hit every pitch that's thrown at me, but I do know that I can give you some insight that's going to be valuable enough to where I would imagine there'll be a second conversation. So I like to provide value as much as I can. So if we get in touch, it's, don't feel that we have to just, hit on something, I'd prefer to make the connection, have the conversation. I do feel that we can provide a lot of value with what we see in the market, with what we've done, and what we're seeing incoming. And we're always connecting with new capital relationships, whether that's ground up construction, value add renovation, takeout refinance, even some of the other fun conversations like joint ventures. Like I said, I'm an investor myself, so I'll be happy to give my insight on either side of that fence.
It's what you need, guys. You need lenders who are going to be creative these days. As I said before, the theme to the movie is creativity for the next couple of years, or heat, as Colby said too, right? So get out of the kitchen, right? But if you guys want to keep going you want to keep the party going for multifamily, you need to have creativity on your team. It sounds like Colby can definitely provide that. So I ask you guys, reach out to him at culbertsonholdings.com. Colby, thank you so much for joining the Cash Flow Digest today. I really appreciate having you on, and we'll certainly have to have you back on once you get that crystal ball fixed, and you and I can talk about what 2024 is going to bring.
Thanks for having me, Matt. It's been a pleasure.
You're welcome. Thanks, Colby. Guys, awesome conversation with Colby today. I really appreciate having him on. Again, I can't say it enough. Creativity on your team is what you need. The market's definitely changing and rates are definitely changing. And the way that you play into that is by having someone who knows and is reading the tea leaves, as Colby is, as to where things are going, where they've been and where they're going, and how you can still stay active even in this changing rate environment. The last thing you want to do is just sit on the sidelines and wait for the market to change. That will not grow your business. Waiting will not grow anything for you. You certainly need to make conservative moves and make the right moves, but there's a lot of wealth that's going to get built in the next year or two for those that know how to play the changing market. That's what I got for you guys today. Thank you for watching the Cash Flow Digest. I appreciate you guys. Hey guys, Matt Faircloth here. Thank you for listening again to the Cash Flow Digest. I really appreciate you guys doing that. If you guys want to hear more about what DeRosa Group has to offer, go to DeRosa Group, DeRosa Group.com, DeRosaGroup.com online. You can hear about all the great things that we offer from an educational standpoint and passive investment standpoint on our website. See you there. And if you guys want to join our online community, DeRosa Insiders on Facebook, where you can watch this program get recorded every Friday at noon Eastern, and you can come on as even a guest or ask questions on the show. We hope to see you guys on our online community, DeRosa Insiders. See you there.